Hey friends, welcome back to the Investing Iguana. You know that feeling when a juicy dividend is just around the corner? Heads up dividend investors, because timing matters. As ex-dividend dates approach, the temptation is strong. But is that next payout actually worth it? Or is it a classic value trap hiding in plain sight? Today we're putting First Real Estate Investment Trust under the microscope. First REIT, ticker A999U on the Singapore Exchange, has its ex-dividend date coming up on August 13th, 2025. This is your chance to find out. Does it deserve a place in your CPF-funded portfolio? Or is it the kind of too good to be true stock you need to dodge? I'm Iggy, your resident Singapore dividend detective. For those new here, I've covered everything from CPF hacks to global economic trends in over 900 videos, clocking over 500,000 watch hours. The Investing Iguana was named one of 2024's influential tigers by Tiger Brokers, and we just crossed 1 million reads. With 58,000 likes from savvy Singaporeans like you, our mission is to simplify investing, one real example at a time. Today, I'll guide you through my 7-step dividend investor playbook, my ultimate checklist for spotting reliable Singapore dividends before the X date. We'll break down each step, apply it to First REIT, and dig deep. Are the numbers solid? Is the yield safe? And do the signals say buy or be careful? Let's preview those 7 essential steps before we dive in. Basic details: dividend yield, dividend sustainability, cash flow and financial health, earnings and business quality, red flags and risks, and finally, Iggy's final score and verdict. Ready? Let's go. Step 1 is basic details. Here's our starting line. First REIT, SGX ticker AW9U. Upcoming ex-dividend date, Wednesday, August 13th, 2025. If you own shares before this date, you'll be eligible for the next payout of 0.55 Singapore cents per share. This reminder is not just for FOMO, it's to anchor our analysis. Step 2 is dividend yield. Let's talk yield. First REIT offers around 8.5% as of August 2025. Now, is more always better? Not so fast. While our Singapore dividend target zone is 3 to 7%, a yield above that hints at either an undervalued gem or a riskier play. An 8.5% yield means you're getting more income, yes, but it's high for a reason. Does the income outpace the risks? With rates this high, the market's signaling caution. Check your expectations. Is that yield sustainable over the long run, or is it a little too sweet? Step 3 is dividend sustainability. Here's where it gets technical. Don't worry, I'll keep it simple. The payout ratio for First REIT is currently around 75%. Our ideal is 35 to 55%. 75% is stretching it. A higher payout means there's less buffer for bad quarters. Add to that a dividend coverage ratio of about 1.2 times, just at the safety line. Ideally, we want to see greater than 2.0 times, which means earnings cover payouts with room to spare. Dividends for First REIT have been consistent for 18 years, but keep in mind, history shows the payout has been shrinking. The distribution per unit for the first half of 2025 fell 5.8% year on year to 1.1 Singapore cents. When your Agong says last time dividend better, he's not wrong. That drop matters for future returns. Is this a red line? Not yet, but keep your calculator handy. Remember, consistency is key, but shrinking dividends knock long-term returns. For CPF or SRS investors, this could impact your compounding plan. Step 4 is cash flow and financial health. Let's talk cash, the lifeblood of any business. First REIT's free cash flow trend for 2025 is positive but not growing strongly. In Singapore, we want to see cash flows steadily rising. The FCF coverage ratio sits at around 1.2 times. Translation, they have just enough cash coming in to pay those dividends, but not a wide safety net. Debt-wise, First REIT's debt-to-equity ratio is 41.2% as of June 2025, which looks conservative versus the typical healthcare REIT industry average of around 70 to 80%. On one hand, lower debt means more stability and less chance of trouble if interest rates rise. On the other, it may mean less firepower for growth. What does this mean for retail investors and CPF users? The balance is decent for now. First REIT isn't overstretching itself, but don't count on rapid expansion or bigger payouts until cash flows increase. The good news is their cost of debt fell to 4.8% in the first half of 2025, down from 5% at the end of 2024, thanks to falling Singapore interest rates. Quick break here. If you want to deep dive into the numbers and get a downloadable, interactive version of my exact 7-step checklist for First REIT, plus the full written analysis, head to the Investing Iguana Substack. The link's in the description. There you'll get all the financial details and my personal play-by-play assessment. Back to the steps. Step 5 is earnings and business quality. First question, are earnings steady? First, REIT's distribution per unit dropped 5.8% year-on-year for the first half of 2025. Not dramatic, but it shows actual volatility. This was mainly due to currency headwinds as the Indonesian rupiah and Japanese yen weakened against the Singapore dollar. However, in local currency terms, rental income from Indonesia assets actually grew 5.5%, while Singapore properties saw 2% growth. On the moat question, First REIT's strength is in its narrow focus on healthcare, especially in Singapore and Indonesia. These are real brick-and-mortar assets, mostly locked into long-term leases. The portfolio maintains 100% occupancy with a weighted average lease expiry of 10.1 years. That's your moat. Healthcare tenants rarely move, so income is usually steady barring market shocks. But foreign currency can whipsaw those rents. Indonesia's rupiah against the Singapore dollar is not always your friend. For Singapore investors, a REIT with a clear moat adds reliability to your income stream, whether it's for funding your CPF, SRS, or that dream staycation. But if the moat starts showing cracks like shrinking demand or regulatory shakeups, those dividends can dry up. Step 6 is red flags and risks. Now for the tough love. Is First REIT's yield a trap? At 8.5%, it's high, but below that 10% danger signal where you really hold your nose. The payout ratio isn't at the 80 to 90% cliff, but at 75%, it's too close for comfort. As for the sector, healthcare is stable long-term. And in fact, healthcare S-REITs have been the top-performing subsector in 2025, delivering an average total return of 6.2% year-to-date. This significantly outperformed the broader S-REIT index, which fell 1.1%. But for First REIT specifically, currency risk from Indonesian assets, rising rates, and regulatory tweaks are real threats. There's also an ongoing issue with rental arrears from PT Metropolis Propertindo Utama, totaling about 7 million Singapore dollars as of June 2025. While there's security deposit coverage for the hospital portion, this adds uncertainty. Will government changes, especially for overseas assets, crimp returns? Will competition eat into yields? A falling rupiah, more taxes, or surging interest could hit next year's payouts. If you're using CPF or SRS funds, know that Singapore REITs have to be especially robust to pass the long-term test. The good news is that Singapore maintains dividend tax exemption for REIT distributions received by individuals, unlike some neighboring countries that have introduced dividend taxes. Now for step 7, Iggy's final score and decision. Let's wrap this all up. Here's the checklist scorecard. Strong on yield, history, and stability with 18 years of dividend payments. Passes minimum coverage and leverage benchmarks, but with little margin. The healthcare focus provides defensive characteristics in an uncertain market. Weak spots include the payout ratio is high, dividends are dropping, and sector risks are not trivial, especially currency exposure. So what's the score? Based on my dividend checklist, I'd give First REIT a 6.5 out of 10 as a dividend play. Here's my verdict. If you're seeking near-term income and your CPF or SRS allocation has room for moderate risk, First REIT will deliver steady distributions, though it's not likely to grow fast. The healthcare sector's defensive nature and essential service characteristics provide some stability. But if you're chasing strong inflation-beating growth with rock-solid safety, there are stronger options in the S-REIT universe. I see First REIT as a cautious hold. Collect the payout if it fits your risk profile, but don't overweight it and keep a close watch on its future distributions. The strategic review of the Indonesia portfolio could provide upside, but currency volatility remains the key risk to monitor. Let's quickly recap. We've taken First REIT through my dividend investor playbook, step by step. We checked the yield, the sustainability, cash flow, debt, and sector outlook. No stones left unturned. Remember, don't get blinded by headline yields. Systematic evaluation is your friend. That's what builds long-term, low-stress wealth in Singapore. If you want your financial journey to be smooth, steady, and set for the long term, remember this. It's not about finding the highest yield today, but the most reliable payout tomorrow. If you enjoyed this full checklist analysis, please drop a comment and let me know which stock you want Iggy to break down next. Give this video a like, share it with your friends, and subscribe to the Investing Iguana channel so you never miss actionable Singapore-focused finance content. So we've walked through my 7-step dividend investor playbook for First REIT and given you the full analysis. If you found this video helpful and want to seriously level up your investing game, please give it a like, share it with your friends, and subscribe to the Investing Iguana channel so you don't miss our next insights. And for those who want to be truly ahead, our premium members gain exclusive early access to all our videos, often a full week before anyone else sees them. This means you get Iggy's detailed analyses and urgent insights on major market moves directly to your inbox, giving you a significant head start. It's just $1 a month, less than a cup of coffee. Think of it as your consistent daily dose of financial fuel for smarter decisions delivered before the masses. Ready to join the inner circle and get that early edge? Just click the link in the description below to become a premium member today. One last tip. If you want to go even further, check out my video on how healthcare S-REITs are quietly winning in 2025. It's a game changer, especially for understanding the broader healthcare property sector in Singapore. The link should pop up right about now. Thanks for joining me, friends. Remember, it's your journey, your money, and your future. I'm Iggy, and I'll see you at the next Ex-Dividend date.